In today's video, let's discover 6 steps that I always pass through before investing with the goal of beating the market over the long run. So the first step is investment ideas. The goal is to generate interesting investment ideas. So what do I use for this? So you can use social media as Twitter, YouTube. You can follow some people that have some good history, that have some investment theory and strategies that are resonating with you. You can get some great, I'm not saying advice here, but some great intel about some stocks that you would not think about by yourself, or that you would not find if it wasn't from them. The second source that I use is Super Investor. It's probably even the main one with screeners. Okay, so Twitter and YouTube, it's the third one. Super Investor and Screener are the top 2 that I use. So Super Investor, I have a list of 5, 10, 15 investor, fund manager that I respect, that I really like the work that they do, and I follow. Okay, I follow on Dataroma the 13 Fs that I have, and every time they have a new position, I'm trying to understand why did they pick this company, why did they invest in it. When they have some company which are 10% of their portfolio, I'm trying to understand, okay, why is it such a big conviction for them? So this is as well a nice source. I recommend you to find some name, 5, 10, 15, as you want. And of course, search some that have the same investment philosophy than you. And obviously some that have a proven history of beating the market, because technically it's probably they know something better than others and something more about investing. And then screeners, I think you know how to use a screener. You just put the data that you want about the company, and you will have all the companies that follow this data, that have this data. So it can be growth, return on invested capital, margins, debt, etc. When I get an idea, I pass to the second step. The second step is to sort this. Okay, so I will use some sorting criteria. So the first one, I want a company that is able to grow its EPS by at least 8% for the last 5 to 10 years, which means that all the companies that are not profitable or are profitable only since a year or two, I don't invest. Okay, I don't take this risk. Maybe I'm passing next to some amazing opportunities, but I prefer to wait 5, 10 years that those companies have a biggest historic of track record, and then invest. Okay, like this. Most of the time it's very speculative and volatile companies that don't have this, so I'm fine with this. I know that I will miss some opportunity with this, but it's fine, okay, because generally the odds are not in your favor if you go on recently profitable company. Then I will go to return on invested capital. So I put return on invested capital, but it can also be return on capital employed and ROE, and return on equity. I check those 3 because sometimes, because of accounting tricks and so on, the ROE can be very high, but those 2 very low. Or sometimes one will be low and the 2 will be good, or only one will be good, the 2 other will be less good. So I want to compare those 3 to see if there is some coherence. The best is that those 3 are around the same level. Okay, those 3 are around 15%. If, for example, we have return on invested capital, which will be 16%, return on capital employed 17%, and return on equity 19%. Okay, if we have something like this, it's something that I like. I want operating margin to be 15% or more. So this means that some areas, some industries will not fit. I'm thinking, for example, of company like Walmart, Costco, that have 6 or 5% operating margin, which is normal for this kind of business. But I'm not saying it's red immediately, okay? But most of the time, when it's not over 15% operating margin, I will just pass, okay? I will just pass because generally, in most areas, if you don't have operating margin at 15% or more, it's because the management is inefficient, the company is inefficient, so there is not a lot of money to make, and it starts to be too dangerous. Of course, there is some exception. I'm thinking, for example, of Amazon, which is in my portfolio, which have an operating margin around 10 or 11% right now. The reason is because I believe that in 5 years, they will have operating margin higher than 15%. Okay, but generally, I try to avoid them. I'm not saying that investing in Costco is bad, okay? The history shows that it's good, but especially if you're beginning and so on, try to focus mostly on company with over 15% operating margin. And then you can start, when you have more experience, you can try to compare with different companies from the same area to see if, okay, maybe the whole area, which is only 6% operating margin, so then you can maybe invest in one of the best in here. I want low debt, and this is for every company. I want net debt to EBITDA under 3, which means most of the time with this that you will avoid utilities, you will avoid rates, okay, because they have around 4, 5, 6 net debt to EBITDA, which is normal for this industry. And I don't want a cyclical company. I'm putting here full cyclicality. What means full? It's a company that's in the last 30 years. You have 3 years go up, then it's flat, go up, flat, and so on. I don't want this. I prefer company with eventually slow but sure growth. I don't want companies that go up, then down for a long time, then up, then down, because it means that you need to time the market for this. You need to be at the good point to invest and to be present the good days. So I prefer to avoid this because generally it's not the kind of companies that I can keep in my portfolio for 10 years and forgetting about them. When I sort the company, okay, when all these criteria I meet, I'm doing a scoring. So what is the scoring? I will score about growth, efficiency, allocation, dividend, debt. I will show you the table that I use, the Google spreadsheet that I use to help me score. So to score the company, I'm going into all of this and I put the data for the revenue, how it grew, EPS same, free cash flow same, interest coverage, debt to EBITDA, all these criteria. And thanks to this, I put some formula here that create for me a score. Okay, I base those formulas with a lot of studies that I found on stock market, and then I have a full score here for the company. Okay, I have a score that will take in account the value, that will take account the dividend or not, because some company will not have a dividend, and it's not because they don't have a dividend that they should have a lower score, etc. For me, when you want to score a company, there is two things that are really the most important. It's debt and efficiency. Efficiency number 1, debt number 2, and growth. Like those 3 are extremely important. They are all important here, but if you want to put more weights on one, it should be on efficiency, debt, and growth, because debt, if it's very high debt, it will be problematic. Okay, it can be very problematic for a company. Same, if they have zero revenue growth or it's a negative growth, they are decreasing, this is really not good as well. And efficiency, generally, when they don't have growth, the efficiency is not good. And I like to have efficiency and growing efficiency, something that I really like. Allocation is also important, okay, but I find it a bit less important, especially now with the tech companies that you can see high stock-based compensation. Obviously, you don't want to have too bad stock-based compensation. You don't want it to be higher than 10, 15%, okay? But it's fine, okay? It's like more and more that you have a lot of stock-based compensation, while to operating cash, capex to operating cash flow, I want it to be under 20%, but generally with those score, I will put higher grade for efficiency, I mean higher importance for efficiency, growth, and debt. Once the scoring is done, I value the company. This, I do a DCF. You have a video on my channel to explain you what kind of DCF I do. The goal here is to classify company from their valuation. And all the companies that I value, it's because I estimate that they are good. Okay, they have good scores, they enter in my strategy. If they don't have a good score, if I don't like them, I don't value. I don't waste time with value, even though if it's kind of fast, but I don't waste my time. So with the value, I want to give priority in the full analysis, because this thing is the shortest thing. Okay, it doesn't take a lot of time, but this analyzing the business and competition take time. So I don't want to spend a lot of time on something where I know that the company will not interest me, that already the number I don't like the number, or the value is way too far from a nice level. I'm not saying like if the value is far away, don't put it in your watch list, don't look for it. I'm just saying that when you're studying multiple stock, focus first on the ones that are closer to a fair value, because you may have an opportunity to enter sooner, okay? So once this is done, I go on the business. I study the business. So here I will do a SWOT analysis. So SWOT is strength, weakness, opportunity, threat. So strength, weakness is internal to the company. Opportunity and threat is about the market, where they are, okay, the competition, and so on. I have also a 30 question framework. Let me know if you want me to share it with you, the 30 question. Basically, the goal is to understand the business perfectly, okay? Understand who is the CEO, what is his history, who are working here, what is the mentality in the company, everything about the company. Who are the competitors? What is their product? Why their product is better? Like really to understand things that are not in the numbers. Okay, here it's really to understand the company, the moat, if they have a competitive advantage, if yes, which kind of moat do they have, etc. And I want to also analyze the competition. Are they leader on the market? Who are the competitors? I need at least to find 2 or 3 competitors every time. Do they have a chance to outperform them? Because as I told you, the goal is to outperform the market. So when you have 2 or 3 companies in the same field, you want the ones that have the most chance to outperform the other. You don't all the time want the ones that have the highest market share. You want the one that is able to outperform. I'm thinking, for example, when you compare Arista Network and Cisco, Cisco is still the leader in the market, but Arista is gaining share of this market and it's really outperforming. So you prefer to be invested in Arista than Cisco in time like this. Ideally, I want the companies that I'm analyzing or the company in which I will invest to have higher return on invested capital than competitors, higher operating margin, lower debt, and higher customer satisfaction. This customer satisfaction is something that I try to care a lot because generally, history has proven that business that can be for a long time on the market and continue to grow, they have high customer satisfaction or at least higher than competition because it allows them to gain new customer for less money because people are recommending the stock, are recommending the company, the product, etc. So I want to have companies that have a good customer satisfaction and potentially higher than the competition. And also I like when I see the return on invested capital and operating margin growing while for competitors declining. This shows that they potentially have a really good advantage on them, and that's something good for the long run. So this is the six steps that I use every time I'm analyzing a company before doing an investment. Let me know if there is some other things that you do. I will be happy to read in the comment and maybe it will inspire me to improve my process before investing in a company. So share with me everything in the comment section and I will be happy to read it. I see you in another video. Bye.